This week marks the beginning of the third quarter earnings season out of the US. And of course, this is just a fresh catalyst for markets to either move towards the upside. Remember, it wasn't so long ago that we saw fresh record highs for US indices, or extend the losses that we've seen recently around the US-China issue. And certainly the initial earnings that we've seen from some of the big banks on Tuesday do signal the potential for the weakness that we've seen recently to continue, or certainly a degree of sensitivity. So within this video, I just want to take an overview of the upcoming third quarter earnings season out of the US. So let's look at the sort of structure of earnings season as a whole in terms of when you should be expecting different key earnings to be coming out. As you can see here, it's essentially a bell curve where you see a sort of introductory phase and you really ramp up into the mid part of earnings season and then taper off towards the back end. As you can see here, that the sort of more prominent week that you're going to be looking at is roughly the beginning of November. So in a few weeks' time, we're going to be peaking and we're building up into that. Generally, you're going to see themes playing out over certain weeks of earnings season. The first theme is around the banking sector, the financials, and we've seen that underway today. This is Tuesday. We've seen the likes of Goldman Sachs and JP Morgan, Wells Fargo, BlackRock, and some others coming out with their earnings today and over the course of this week. Notably, we've actually seen some of those names outperform across both top and bottom line, the likes of earnings per share and revenues coming in better than markets expected, and not necessarily seeing huge sort of deterioration in terms of the outlook going forward. But nonetheless, we're seeing selling pressure coming into play in early trade. It's a warning sign of the fact that generally what we have seen for many of these earnings season, particularly where you see elevated valuations within the market, is that outperformance against market expectation, the reaction from a market perspective can be relatively muted. You might see some gains, but let's say you beat market estimates, you might rise 2%. You underperform, or you provide an outlook which signals a tough road ahead, and you could drop 5%, 6%. So a lot of the time it's sort of weighted more heavily towards losses around this earnings season. But generally, companies do outperform earnings, and that might be part of that dynamic as well. So in terms of the expectations for earnings per growth, what we can see here is that the rate of growth on the earnings front is expected to ease off at the back end of this year. That's probably not surprising because we've been through a period of upheaval when it comes to policies, when it comes to the relationships around the world in terms of trade, in terms of tariffs and the like. But that's expected to pick up quite significantly for the next year. That points towards the possibility of strong performance when it comes to, say, the S&P 500, the NASDAQ, and the like for next year. And perhaps a little bit more of a bumpy road where it comes to the back end of this year, in particular how businesses are trying to address the new world order, so to speak, or the new environment with which they are operating within. So you can see that sort of tapering off in terms of the growth of earnings per share expected. Now, in terms of the sort of sector-specific outlook, we can see that here. So the expectations, according to FactSet, point towards the best performing sector in terms of growth, likely to be the information technology grouping. So once again, the tech crowd at the top here. At the bottom end, energy, once again. I mean, I can't remember the last quarter we didn't see the likes of energy towards the bottom. Generally, materials at the bottom as well with them, but we're actually seeing materials. The expectation is that they're towards the top end of it. Notably, you can see also the sort of upgrade or downgrade in terms of expectations for some of these different segments. So, for instance, there's an expectation that the technology names are going to do well. You can see here 20.9% average earnings per share growth expected. That figure was roughly 15.9 on the 30th of June. So over recent months, you can see that in actual fact, that has increased significantly. Where have we seen significant decreases? Well, materials, a lot of that will be associated with commodity prices or underlying commodity prices. Financials, significant upgrade. In part, that's going to be because of the fact that we've seen sort of interest rates remain elevated, but we've not necessarily seen a recession or anything like that. So that should point towards a decent period for the financials. But that's not only banks, remember. Industrials weaker than previously expected. The S&P 500, in actual fact, an upgrade in terms of the expectations, previously 7.3, now at 8.7. But you can see here roughly where we're expecting the significant growth to come in. In terms of margins, I think this is going to be a really important part of it, certainly depending on the sort of segment we're looking at. If we're looking from a sort of sector-specific area, what are the areas that are going to be impacted heavily by, say, tariffs, for example? Well, the likes of consumer staples, consumer discretionary in particular, some of these businesses like materials that are going to be impacted by the tariffs, by some of the policies under Donald Trump. But in actual fact, the estimates that we can see here do signal the expectation that margins will continue to rise as time goes on, which is good for the market as a whole, because that means essentially you can see revenues flat, but still see earnings per share increase over time as a result. Now, you can see this is a sort of a picture in terms of which of the segments over the course of recent months we've seen a significant upgrade in terms of the expectations of where earnings will be. You can see in actual fact, energy, tech, communication services. So again, that's sort of very similar to tech. The financials, those are the areas where we've actually seen recent upgrades in terms of market expectations around where we're going to stand at the end of this earnings season. So notably, as you see sort of oil prices stabilizing and trying to gain a bit of ground, that's where you start to see this sort of expectations around energy doing particularly well. And then you've been seeing many deals in the tech space coming into fruition. So it builds a narrative around increased demand and economic activity for some of those AI names in particular, and the chip stocks. Onto that sort of focus around the sort of big tech names. Now, this is an iteration of a chart that I've seen quite a lot and brought up to you guys quite a lot over the course of, say, the past year. And that is the expectation that the growth rate of earnings for the Mag 7 names is expected to drop off. It already has been dropping off a bit, but it's expected to more significantly normalize after sort of rapid growth that we saw back in sort of 2023 in particular. That normalization is expected to come at the same time that we see a resurgence in terms of the growth rate of earnings for the rest of the market, the rest of the S&P 500. That by and large keeps getting pushed back, right? So the expectations of when are we going to see this massive surge in terms of massive, but like significant surge in terms of earnings per share growth for the rest of the S&P 500, it keeps being pushed back. It's now 2026. Previously, the expectation was that we were going to see it really significantly push higher at the back end of 2025. That's not necessarily the case now. So we're seeing, in actual fact, for the final quarters of 2025, the expectation is that we see a narrowing of the differential between the two, more borne out of weakness on the Mag 7 growth rate rather than much of a pickup in terms of the rest of the market. But certainly there is a hope that there will be a pickup, and that pickup could be attributed to Trump's policies. That could be attributed to the likes of AI sort of providing a boost to the rest of the market. But certainly at the moment, the sort of AI story really is born out of sort of business to business activity, which is what we've been seeing recently in terms of deal making as much as anything. And yeah, it's been the Mag 7s that have really been benefiting the most from the AI wave. And then in terms of tech companies, it's notable, you know, of course, right now there's a big theme around the overvaluation or perceived overvaluation of big tech. And so I just wanted to bring this to your attention, which is that according to FactSet, we've seen in terms of guidance coming into this earnings season, the number of tech companies issuing positive guidance surging towards the upside over the course of this quarter. So there is an expectation that we will have a good quarter from tech, and where tech goes, the rest of the market often follows. And in part, that's because of this dynamic, right? Because essentially, as long as tech are doing well, there's an expectation that the rest are all going to follow. But there's always this like, oh, it's going to happen in a couple quarters' time, right? So will tech do well? If tech does really well, that should really lift markets as a whole, because earnings season will be put down to, well, the thing that's driving all of these gains continues to be strong. And we know that the rest of the market is soon enough going to pick up as well. And we're expecting to see that resurgence in terms of growth rates from there onwards. This is incorrectly titled, but essentially this is perhaps one of the most important charts, and it really sort of gives you an idea of why we're so interested in earnings season. Of course, on a company by company basis, it's very obvious. If you're investing in stock, you want them to post strong profit growth, improve margins, you name it, strong outlook. But this is the relationship between the forward 12-month earning per share and the price of the S&P 500. Essentially, the growth of earnings for the index as a whole is key to maintaining the long-term uptrend that has essentially underpinned US stocks. And there is an expectation that we will continue to see that. If we sort of cast our mind back, here we go, earnings per share growth over the course of the coming year and a bit. So the expectation is that actually next year it's going to ramp up and be even stronger than where we are at the moment. So as long as we continue to see strong earnings growth, then we should continue to see strong S&P 500 growth. Of course, if you see, as we've seen recently, a wide disparity between the growth of earnings, or where the earnings per share figure is, and where the S&P 500 figure is, that means that you've got elevated valuations or elevated multiples. So if you see elevated multiples, then you better make sure that your earnings actually come in strong, because as we've said at the moment, markets are geared towards underperformance. When you have highly valued stocks at high multiples, if they don't match those elevated expectations, then those multiples come into questions, and you quite quickly see that stock unwind as it sort of undermines the growth story behind that. And in particular, it's the tech sector that really has to watch out for itself. As long as they continue to post very strong earnings, then everything's fine and we continue to move towards the upside. As soon as that starts to turn around in a meaningful manner and we see underperformance, that's where things could get quite sticky. So the tech sector remains key in all of this story. And certainly if we are to see continued strength from the tech sector, great, then we should continue to see the likes of the S&P 500 gaining ground. But if we do see that undermined and we start to see the numbers coming lower than expectations, which we're not used to over recent years, that's where we could really start to see the market as a whole starting to roll over. Just to round things up, I wanted to show you the S&P 500. It's already been a bit of a topsy-turvy day. And I'm thankful to say that stocks are starting to turn higher once again. You can see here in terms of the S&P 500. So that sharp collapse on the Friday, the rebound on the Monday because of the comments from Donald Trump. Now we've seen a decline into this horizontal support level, which is sort of roughly around that 65.51 mark. We've come in, tagged it once again, and now the bulls are back in play once again. Like I said, some of the stocks sort of in early trade certainly weren't looking too handy. I'm just going to quickly check them. I won't bring it up on the screen here. So JP Morgan Chase still 2.5% down. They beat market expectations. Johnson & Johnson down 0.8%, but that was significantly lower than that. Goldman Sachs down over 3%. So some of these stocks have outperformed estimates, and they're still significantly lower. So it really highlights that it's a bit of a minefield out there. And if you're looking for outperformance and it underperforms, that's where you could see the volatility within this earnings season. But as I've shown you on the last chart, this earnings season will, of course, be absolutely critical for the direction of travel for the S&P 500. As long as we continue to see strong earnings growth, then it underpins that long-term uptrend. And as everyone knows, the S&P 500 returns 10% every year over the long term. Well, in actual fact, it returns 10% as an average, but very rarely does it return 10%. Often it's 25%, or it could be 2%. And we hopefully maintain that upward trajectory that we've seen over the past couple of years, where we've seen over 20% gains for the S&P 500. And for us to see these kind of gains, we need to see earnings growth maintaining its strong upwards trajectory. The key to that really is going to be strength for the tech names. I hope this has been useful. Make sure to like, subscribe, follow for more, and we'll try to help you navigate not only the economic data, but also some of the earnings data. Thanks a lot. My name is Joshua Mahony, Chief Market Analyst at Scope Markets.